Welcome to this week's special presentation titled The Case for Small Caps in a Large Cap World. My name is Todd Shaffer, Manager of Research for VectorVest. I'll be your presenter this evening. Large cap stocks are known for their stability and reliability, often delivering consistent dividends from well-established companies. In contrast, small cap stocks come with higher risks, but can offer significant growth potential. Small caps can play a key role in your portfolio. Many new investors make a common mistake. They judge a company's size by its stock price alone. They might think a company with a $500 stock price automatically is bigger than a $50 stock. But a stock's price alone doesn't tell you its size. A $500 stock could belong to a small or large company depending on the number of shares outstanding. And there's the answer to the question. Market cap is the product of the current share price and the total number of outstanding shares. Companies are grouped by their market cap size, from tiny nano-cap companies worth less than $50 million to massive mega-cap giants worth over $200 billion for the category, but we have large stocks now that are worth trillions of dollars. But imagine a company with 20 million shares selling at $100 a share has a market cap of $2 billion. Another company with a share price of $1,000 but only 10,000 shares outstanding has a market cap of $10 million, half the size, even though its price is 10 times higher. So market cap can change with a change in share price or a change in stock issuance. For instance, buybacks or dilutions will change the number of outstanding shares and therefore the market cap of the company. So market cap as a tool for valuation is rather limited for our purposes, but market cap can be very helpful because it helps us understand risk. Large cap companies typically have more resources to weather economic storms. For instance, a $100 million financial hit might barely dent a $1 trillion company's bottom line, while the same loss could bankrupt a smaller firm. And that's why you see in the VectorVest system of analysis, large cap stocks get higher RS or relative safety ratings. Now contrast those large cap companies with small cap companies. They don't have that financial cushion, but they often have more room for dramatic growth. So it's a lot easier to double in size when you're worth $100 million than when you're worth $1 trillion. So if we think of market cap and the implied risk and reward combinations, then we see on those large cap stocks, them being more stable during economic uncertainty, which will score as lower risk. These corporate giants have substantial cash reserves, diverse revenue streams, and established market positions. However, because of their size, they usually grow much more slowly than their smaller counterparts. Now, mid-cap companies are kind of in that middle ground. Right? A little riskier than large caps, but also with more potential for growth. So we'll score them as mid-level risk and mid-level reward. Small cap stocks historically offer the highest growth potential, but also a greater risk. This difference becomes especially important when interest and inflation rates are high, right? As these smaller companies often struggle with debt payments and higher operating costs. So while these generalizations are fair, the market actually favors different market segments, different market cap segments, as the market cycles. Think of risk on and risk off situations where you might favor large cap stocks because of their safety. Or we're in go-go mode where you might favor small cap stocks because of their high rewards. While there are generally three main market cap groups, we can get more granular. So let's start at the top. We'll start with those mega caps. These are stocks, there are companies that have market capitalizations of over $200 billion. And as I said, the largest stocks we have now are worth trillions. Large cap stocks have capitalizations between $10 billion and $200 billion. So depending on the source, some may group them together and call them all large cap, any stock that has a capitalization over $10 billion, would then be considered a large cap stock. But in either case, these groups represent the major players in well-established industries and sectors. These guys are considered blue chip stocks, relatively stable firms. They're generally reward investors with consistent increases in prices, although not fast increases, and dividend payments. Mid-cap companies, the next tier, generally have market capitalizations between $2 and $10 billion. Mid-cap companies are typically still in growth mode and, of course, bring an inherently higher risk than their large-cap cousins. And that risk can often express itself as more volatility. Small-cap companies have market caps between $300 million and $2 billion. While the bulk of this category consists of relatively young companies that have a lot of potential, these small companies may serve niche markets and or new industries. These companies are considered higher risk investments due to their age or lack thereof, the markets they serve, and of course their size. So small cap share prices may be more volatile but provide greater growth opportunities than large caps or even mid caps. Now you can take the small cap group and divide it further. The first subset would be microcap stocks. These are stocks that have capitalizations between 50 million and 300 million. Microcaps will include a lot of penny stocks, so very small companies, and will probably have pretty small or limited trading volumes. Below microcaps, we have nanocaps, stocks that are less than $50 million. These stocks will often fall into the speculative group, where we're looking for home runs on the capital side. So for the purposes of our conversation, we'll focus on large, medium, and small cap groups. But let's turn the corner and examine the performance represented by each of these groups and how we might be able to take advantage of it. We're going to use two tools within the VectorVest system, the performance graph and quick test. I've opened the program, and often our conversations around market caps will be in the context of the major indices as we loosely correlate the index with certain market caps. But there's a lot of overlap here. So I've decided for this presentation to change it up here a little bit. We're going to go to the Viewers tab, and let's take a look at the Market Index Viewer. So what I'm interested in coming up with is an index that will serve as my proxy for small cap, mid cap, and large cap stocks. So I'm going to use the S&P 500, the SPX, the small cap 600 SML, and the mid cap 400 MID. I'm going to go to MID, I'm going to right click on it, and I'm going to choose View Stock Graph. The stock graph opens, and I'm going to change it from a stock graph type to a performance graph. Now, of course, you could open a performance graph directly and just type symbols in. But here I've opened up a performance graph. It's comparing SML to its larger group market indices. I'm going to take that off. And I need to add the other two indexes, the MID and the SPX. And let's click on them. And I'm going to change the color of MID just because that white doesn't pop very well. So I'm going to right click, change the style. That opens up the series color window. I'm going to change that line style. Let's try yellow. And see if that doesn't help us. That's a little bit more visible. So a performance graph takes the items that are checked, adds them to the graph, and compares their performance over a time frame, in this case 1 year and 2 days, from a common starting point, 0. And compares their performance over that time frame. So you can see as a group, all three of those indices are up about 30% on the year. But I also noticed that it hasn't been a straight shot. If I take my pencil, I notice that early in the year, small caps were outperforming. In the spring, mid caps were performing. And for the second half of the year, the SPX was performing. But the point is, over this past year, they've each had their time in the sun. The other thing I notice is that oftentimes they'll move together, as in this period here, but there are other times when they diverge. For instance, the SPX was improving while the small and mid caps were declining, a divergence. The other thing I notice is that there are periods when there was great acceleration, for instance, here with the small and mid cap stocks relative to the SPX, and that happened also here at the beginning of the year. And I even see one here in late summer. So these represent great opportunities where you're getting much faster growth rates, or I should say price accelerations, relative to the other market cap segment. Now, if I take off those lines, what I'd also have you notice is this was the 1 year perspective, but our perspective changes when we look at 6 months. Now small cap is in the lead. 3 months. Mid cap's in the lead, although small and mid caps have performed pretty close to each other in that 6-month period. And on a 1-month period, small caps back in the lead. Now the other thing I noticed is on that 3-month graph, small and mid caps were at the top of the list, but look at the volatility they experienced in that 3-month period. So broadly, they all had positive performance over time, but there were opportunities to optimize or maximize the performance of your portfolio by moving in and out of these different market cap segments. Now, I like the graph because it helps me see or visualize the volatility, the acceleration rates, the slope of the line, that kind of thing. But I can also measure that performance using the quick test tool. Let's close this graph. And again, just right-click on one of the highlighted stocks and click Quick Test. This opens the Quick Test window. Let's test the same time frame. So that was back in August on the 26th. And run the test. So here we can see the performance. Let's sort that so that we have the mid-cap stocks at the top of the list over the last 3 months, right? Followed closely by the small caps, which both outperformed the S&P. The broad market, as defined by the VVC, was up 7.25%. So this harkens back to that conversation of the broad market in that time frame was up 7.25% as represented by the VVC. The smaller slices of the market, well, the small and mid cap stocks outperformed the broad market. The S&P correlated closely to the broad market. So how do I take advantage of this information? Well, simply jump on the fastest moving train. When you identify the fastest moving market cap segment, we can buy stocks in that segment. First of all, you could just trade the index itself or an ETF that tracks that index. Or you can trade stocks that are included in that index. So for instance, let's close out our quick test and go to the watch list viewer. And in the S&P watch list folder, the S&P 400 mid-cap watch list includes all of the stocks that were in that mid-cap index. And of course, right below it is the S&P 500, and at the bottom, the S&P 600. So here I'm looking at the stocks that are included in the index, and by virtue of our VST system, we've brought to the top of the list the stocks that have the strongest combination of value, safety, and timing. So if you want to examine stocks that are in this market cap segment, I would simply suggest you take a look at the top VST stocks and their graphs. And let's just start with VectorVest Simple, right? The graph layout, VectorVest Simple. I turned off the 40-day moving average here, but you can see price. Love that price. Bottom left, upper right, smooth the better, driven by rising earnings. RT tells the story. This thing has been an uptrend all year long. As we scroll through, just pick out the stocks that have the most favorable graph patterns in your time frame, and then apply your trade management to those trades to optimize their performance. Now, another thing you could do is add a market cap parameter to your favorite Unisearch to limit the size of the stocks that are found by the search. But that's a topic for a different day. Bottom line here is market capitalization is important for understanding what kind of company you're buying and its risk. Each market cap category serves a different role in a diversified portfolio. So understanding these differences can help you match your investment choices with your financial goals and risk tolerance. Simple as that. Thanks for watching.
Yeah.